Assalamualaikum warahmatullahi wabarakatuh, guys. Welcome back to our analysis of Islamic banking profitability. We are trying to answer this question: are the Islamic bank in Malaysia making too much profit? So before we get into the answers, it is quite important to highlight some of the fundamental uh, parameter in the banking operation, especially the banking objective. So we know quite well that the performance of banking company are usually assessed using the return on equity parameter, the ROE, and that imply that because the ROE is the product of bank earning divided by the banking equity capital, which is tier 1 capital. And therefore, we expect to see that the bank must or should be able to generate as much earning as they can over the amount of capital that the bank is currently holding that serve to support the banking asset. Whether the banking asset are loans for conventional bank or these are murabaha or tawarruk or sukuk, for Islamic banking. So in order to for the bank to achieve its targeted ROE, then it is common sense that bank must strategize. The bank must find a way how to strategize their way into achieving that targeted ROE. And this is where we need to look at the business and risk strategy of the banking companies. And we can see here that this aspect of the banking operation were highlighted in the Sharia Governance Policy Document 2019, where the central bank have iterated here that it is the board oversight accountability over Sharia governance, meaning that the board of directors are not only responsible for the commercial component of the banking business, but they are also responsible for the Sharia governance. So meaning that Sharia governance is not, the the Sharia governance is not shouldered by the Sharia committee, right? The Sharia committee were given the so-called role to oversee Sharia governance, but the final responsibility of Sharia governance is on the board of directors. So the board's oversight accountability over Sharia governance and compliance, it must reflect the integration of Sharia governance, which meaning that the control of the use of Sharia in the banking business. So meaning that the banking business must be free from riba, gharar, from maisir, from pork, from alcohol, and other prohibited transactions. Right? Consideration within the business and risk strategy of the bank. So meaning that the board of directors must be able to make sure that Sharia governance, namely the Sharia committee members, the Sharia department, and this will of course be involving the Sharia chief risk officer, Sharia chief officer and his subordinates, that Sharia governance and compliance must reflect the integration of Sharia governance consideration within the business and risk strategy of the bank. So meaning that Sharia governance must now be able to see or understand or to appreciate or to ensure that any fatwa or any resolution that the Sharia members are giving away must be done within the business and risk strategy of the bank. So what is it? What is this business strategy or risk strategy of the bank? These are quite complicated. And the question here is whether or not Sharia committee members are able to understand the business strategy and risk strategy of the bank, because this can include a lot of technical things like capital adequacy, regulation, stress testing, and many other new issues, that the Sharia committee member must be able to understand. Capital allocation, for every loan or murabaha that the bank is making, there must be some kind of capital allocation. And what is the risk appetite of the bank? To what extent the bank would be able to do the al-bay contract of sale, leasing, and mudarabah and musharakah, istisna, tawarruk, and all that. To what extent the bank is able to accept risk profiling of this contract. And the risk appetite of the bank is always associated with capital allocation. So are the Sharia governance people able to understand capital adequacy requirement and all of the technical things that they need to understand well to ensure that the bank is actually moving forward to make money or to profit, at the same time holding on to the rule of Sharia. So this oversight responsibility of the board of directors to ensure that the Sharia governance is integrated into the business and risk strategy of the bank is a very, very important agenda that the board must be able to do without fail. And for that reason, we are trying to see that if the bank is unable to make the Sharia committee member appreciate this aspect of the banking operation, namely banking business and risk strategy, then whenever something happens to the banking operation, for example, when the bank make losses, that can adversely affect the equity capital, then who will be blamed for such event? Are these due to Sharia non-compliant risk, or are these due to simply commercial factor like credit risk, market risk, and operational risk, right? Because we know very well that when we look at the Islamic banking business or the banking business in general, the bottom line is profit, right? So we can see here that in banking, equity capital is mainly used to absorb loan losses. So equity capital is not used to make loan. So loans are mainly funded by the cheaper deposit fund, but the banking capital, equity capital tier 1, is used to cushion the loans against loan losses. So any extra losses that exceed the loan loss provision would have to be covered by capital. So capital is a very important component of the banking business because if there is a loss, then capital will decline. If there is a good earning, capital will grow. And if there is a big loss due to bad default or due to a very bad recession, then the bank, will suffer, in capital contraction that can reduce capital, below the minimum level, and that will finally cause the bank to become insolvent. So we do not want to see that happening in the banking business. So we can see that for Malaysia, in 2023, the average return on equity of the banking industry in Malaysia was at 11.6%. That was quite commendable. So it means that the bank make 11.6 cents from every 1 ringgit investment of their equity capital. That is tier 1 capital. So the bank is the bank equity capital is the money that the bank actually owns, and this money of equity capital is used to support the loan or to support the murabah and tawarruk, right? And it is used to absorb any extraordinary loss that exceed the loan loss provision. So it is very important to see the ROE as the ultimate measurement of performance for the banking company. And that is why the amount of equity need to be preserved at least, but it must be able to grow over time to evidence healthy development or healthy performance of the banking company. So we can see that the top 3 Malaysian banks, namely Maybank, CIMB, and Public Bank, made an average net profit of USD 1.29 billion or Malaysian ringgit 5.8 billion in Q2 2023 last year. So this is essentially a good performance of the top 3 Malaysian banks. And so we want to see, what may have caused the Islamic bank, the conventional bank, because this is a data that cover both conventional bank and Islamic bank. We know very well that we have the subsidiary Islamic bank, which is owned by the conventional bank. At the same time, we have the standalone Islamic bank. These are Bank Islamic Berhad, Bank Muamalat, and we have the foreign Islamic bank, and all of these are actually the banks that we will want to analyze concerning their profitability. Okay, guys, we can stop here and then we can further look into this issue later on. I'll see you again. Thank you very much. Assalamualaikum warahmatullahi wabarakatuh.